Are you an investor looking to amplify your returns but confused by the complexities of options or the risks of borrowing? This video is for you. We'll break down why leveraged ETFs often outperform both options and direct borrowing, offering a simpler, safer, and potentially more profitable path to magnified gains. Stay tuned to discover a smarter way to leverage your investments. First, let's understand what a leveraged ETF is. It's an exchange-traded fund designed to return a multiple of the daily performance of its underlying index. For example, a 3x leveraged ETF aims to deliver 3 times the daily return of the index it tracks. It's a way to get amplified exposure without direct derivatives or margin debt. One of the biggest appeals of leveraged ETFs like TQQQ is their simplicity. You simply buy shares of the ETF, just like any other stock. There are no complex strike prices, expiration dates, or Greek letters to decipher, making it accessible even for those new to leveraged investing. Now let's explore why leveraged ETFs often have a distinct edge over options contracts, especially for long-term amplified exposure. These advantages can save you from common pitfalls in options trading. Unlike options, which come with strict expiration dates, leveraged ETFs have no such constraint. If your underlying asset doesn't move favorably before an option expires, you could lose 100% of your premium. With an ETF, as long as you hold it, you maintain your leveraged exposure, giving you time for the market to move in your favor. Options contracts are notorious for theta decay, meaning their value erodes over time, even if the underlying asset stays flat. Leveraged ETFs, while subject to their own decay mechanisms like compounding and fees, do not suffer from this constant, ticking time bomb, giving you more holding power. In a sustained uptrend, the daily compounding nature of leveraged ETFs can lead to remarkable gains. Each day's magnified return is applied to a new, larger principal, potentially creating exponential growth. Options don't offer this kind of compounding effect on your initial investment. Beyond options, leveraged ETFs also present significant advantages when compared to achieving leverage through direct borrowing or margin loans. These benefits focus on cost, risk, and management. Leveraged ETFs achieve leverage at institutional rates, which are typically much lower than what an individual retail investor could get through a margin loan. Furthermore, the transaction costs are generally lower than managing a complex portfolio of borrowed funds. Perhaps one of the most significant advantages over borrowing is the absence of margin calls. When you borrow money to invest, a sharp market downturn can trigger a margin call, forcing you to deposit more funds or liquidate positions at a loss. Leveraged ETFs, by design, do not expose you to margin calls. While all investments require monitoring, leveraged ETFs generally demand less active management than an options portfolio. You're not constantly adjusting strike prices, rolling contracts, or managing complex expiry strategies. Compared to the intricacies of managing strike prices, expiration dates, implied volatility, and rolling contracts in an options portfolio, leveraged ETFs simplify portfolio oversight. You focus on the underlying trend rather than complex derivative mechanics. While leveraged ETFs offer compelling advantages, it's crucial to be aware of their unique risks and characteristics. Smart investors understand these factors before diving in. Be wary of volatility decay. If the underlying asset is highly volatile and cyclical, the daily compounding effect of leveraged ETFs can work against you over time, especially in choppy or sideways markets. These ETFs are designed for sustained trends, not sideways chop. Always check the trading volume of the leveraged ETF you're considering. Lower trading volumes can result in wider bid-ask spreads and inefficiencies when buying or selling, potentially impacting your returns. Prioritize leveraged ETFs from larger fund houses with significant assets under management, ideally over $5 billion. This ensures better liquidity, reduces the risk of the fund closing, and generally indicates a more established and stable investment vehicle. In conclusion, leveraged ETFs present a compelling alternative to options and borrowing for investors seeking amplified returns. They offer simplicity, avoid common options pitfalls, and bypass margin call risks. Remember, while they offer significant benefits like no expiration dates, no theta decay, and compounding gains, always be mindful of volatility decay, trading volume, and AUM. Invest wisely, and may your portfolio prosper.